Ever feel like you're just drowning in information? Endless articles, reports, analyses. It's just so much.
Oh, absolutely. Information overload is real.
Right. And yet you still want to be genuinely, thoroughly informed about the companies quietly shaping our world.
Hmm.
It's a constant battle, especially when you're trying to understand a complex business, its strategies, its landscape, without spending days buried in uh, dense documents.
You want the insights, but efficiently.
Exactly. So you're in precisely the right place today because we're cutting through all that noise. We're distilling the essential, bringing you the clarity you crave.
Okay, let's do it.
All right, let's unpack this. We're diving into CSW Industrials today, ticker symbol CSW. They're a truly fascinating yet, often kind of unsung player in the industrial space.
Yeah, not a household name for sure.
Not at all, but they're quietly building something really impressive, really enduring.
Yeah.
Our mission today, take an extensive investment analyst report on CSW and extract the most important nuggets, the core insights, the surprising facts specifically for you.
Giving you that shortcut to being well-informed.
That's the goal, complete with those aha moments that make the knowledge actually stick.
Well, what's particularly compelling about CSW Industrials, I think, is how a company operating in what might seem like, unsexy industrial niches.
Right, the stuff nobody thinks about.
Exactly. The products you probably never consider until they don't work, how they can consistently generate such formidable results is quite remarkable.
So we're not just going to list what they do.
No, no. We're going to connect the dots. We'll look at their very deliberate strategy and their formidable, almost invisible competitive advantages. You'll understand not just what powers their growth, but why their approach is so effective and so resilient.
Think of it as the ultimate shortcut, then, to understanding why CSW is rightfully called a niche market compounder. They've got this incredibly robust competitive moat.
Mm-hmm. A strong moat.
We'll show you exactly how they achieve that, how their relentless buy-and-build strategy creates these powerful defensive revenue streams from essential maintenance, repair, and overhaul consumables. MRO.
That MRO focus is crucial.
It really is. And crucially, we'll explain why this company often commands a premium valuation in the market. That's a signal, right? That smart money sees something special here.
Definitely something worth digging into.
Okay, get ready. We're going to peel back the layers of a truly resilient industrial force.
Let's start at the beginning, their origins.
Good idea. To truly understand CSW, let's go back to its genesis, its core identity. Now, the idea of a spin-off might sound a bit technical, maybe dry corporate stuff.
Yeah, just corporate restructuring jargon sometimes.
Right. But for CSW, which was established back in 2015, being spun off from Capital Southwest Corporation wasn't just shuffling papers. It was, in many ways, a liberation.
Exactly. A spin-off just means a parent company separates one of its divisions into a new independent public company. So yeah, in 2015, CSW wasn't just founded. It was kind of set free from Capital Southwest Corporation.
Set free, I like that.
And it wasn't just a name change. It was a fresh start with a very clear, very focused mission. Be a specialized growth engine. Focus on manufacturing and marketing niche, value-added industrial products.
So not commodities.
Definitely not commodities.
Yeah.
And the key thing is, rather than sort of evolving into a disciplined, capital-efficient operation over time, that approach was embedded in their DNA right from day one.
Why? Because of the parent company?
Largely, yes. Thanks to Capital Southwest's investment-focused background,
Yeah.
that foundational approach, that discipline is absolutely key to understanding their later success and how they approach pretty much every business decision.
That deep-seated discipline right from the start, it really sets the stage for their core growth mechanism, the buy-and-build strategy. And this isn't just acquiring companies randomly. It's a very specific, highly strategic, almost, artistic process.
Yeah, there's definitely a craft to it.
CSW's central model revolves around this buy-and-build approach within these highly fragmented, niche industrial markets. They actively look for and acquire businesses that already possess leading brands and strong market positions.
Right, they're not buying turnarounds usually.
No, but here's the crucial part. They don't just buy them and leave them alone, they integrate them. They leverage CSW's larger corporate infrastructure, especially that huge distribution network, to basically supercharge their growth and profitability.
Indeed. And it's far more sophisticated than just, rolling things up. It's a strategic process of consolidation and synergy that really amplifies value.
Okay.
A critical component, and frankly, it's a masterstroke of their strategy, is their relentless focus on consumable and essential MRO products.
MRO again. Maintenance, repair, overhaul.
Exactly. Yeah. What are these? They aren't the flashy new machines themselves. They are the lubricants, the sealants, the repair parts, the coatings. The essential items used to protect and maintain incredibly expensive capital assets.
Like industrial machinery, big commercial HVAC systems.
Or even crucial railway infrastructure. And this dynamic creates a demand for these products that is not only recurring, but crucially, relatively less susceptible to economic downturns.
Because you have to maintain stuff, recession or not.
Pretty much. It creates a highly defensive, often non-discretionary revenue stream. So the question then becomes, how do they consistently identify the right targets, those hidden gems in niche markets? And then how do they integrate them so effectively without losing what made them valuable in the first place?
That integration piece is where so many M&A deals fail.
Absolutely. That competency, identifying and integrating, is truly at the heart of their competitive edge.
That's a great point, because you see plenty of companies stumble badly with M&A. Is it just a checklist, or is there an art to it, like an intuition for which businesses truly fit their ecosystem?
I think it's a mix. There's definitely a rigorous process, but also a deep understanding of the markets and the cultural fit.
And it's true. When you talk about MRO, think about it like this. Nobody's lining up for the latest in, like, condensate management solutions, right? It's not a shiny new phone.
Definitely not glamorous.
But imagine a massive data center, thousands of servers, running 24/7, generating incredible heat. That requires a colossal, incredibly complex HVAC system. If one small rector seal condensate pump fails, or maybe a sealant in a duct system gives way, you're not just looking at a little drip.
No, you're looking at potential electrical shorts, millions in server downtime, a massive operational nightmare.
Exactly. CSW sells those critical, unglamorous pieces that keep the entire digital backbone of our economy from, well, melting down. That's why it truly matters.
That's the essential plumbing, literally and figuratively.
Yeah. And the analyst report highlights a great example. The low cost of a CSW product, say a specialized sealant, it's a tiny fraction of the high-value asset it protects, like a $10,000 commercial HVAC unit.
Right. The cost of the sealant is negligible compared to the asset.
So this creates incredibly sticky customer relationships. The end users, the pros, they prioritize proven performance and absolute reliability over saving a few bucks. Price sensitivity goes way down.
They simply can't afford to cut corners on a critical component that protects a much larger mission-critical investment. The risk is just too high.
That's a powerful illustration. It perfectly captures the economic leverage of their model.
It really does. And to truly understand how this strategy plays out across the industrial landscape, we need to dive into their specific operational segments.
Absolutely. Okay, so CSW, in a smart move, realigned its operations into 3 distinct business segments back in August 2021.
Not just shuffling deck chairs, right. There was a purpose.
Exactly. It wasn't arbitrary. It was done to better reflect its diverse end markets, streamline operations, and, importantly, capture internal synergies more effectively.
Makes sense. So what are the 3?
Okay, first up, and this is their biggest engine by far, we have Contractor Solutions. This segment accounts for roughly 67% of their revenue, based on Q3 fiscal 2025 numbers.
Wow, 2/3 of the business.
Yeah, it's huge. It primarily serves the unsung heroes of our infrastructure, the professionals in HVACR, heating, ventilation, air conditioning, refrigeration, plumbing, and electrical trades.
The folks keeping everything running.
Precisely. Their product portfolio here is extensive. Essential items like condensate management solutions, think specialized switches, pans, pumps that prevent water damage. Also, drain and vent system products, refrigerant locking caps for safety and security, specialized tools for installing ductless mini-split systems.
Stuff technicians use every day.
Exactly. Plus, a wide array of sealants, solvents, maintenance chemicals. Key brands here include Rector Seal, founded way back in 1969. Decades of trust there.
Rector Seal is a big name in the trades.
It is, and they've strategically augmented that with acquisitions like TO Air in 2020. They make grills, registers, diffusers, and more recently, and this was a big one, Aspen Manufacturing in 2025. Aspen's a major player in evaporator coils and air handlers.
So really building out that HVAC offering.
Definitely. Revenue for this segment comes mainly through well-established wholesale distributors. Those distributors are vital for reaching their professional customer base.
And what's fascinating here is how they've systematically built these segments around established, Trusted brands that have earned their stripes over decades. Then they significantly augment them through strategic acquisitions like Aspen.
Right, adding capability.
Exactly. Aspen, for instance, is a major player in HVAC components. Integrating it instantly expands CSW's footprint and product offering in a critical area. It creates this powerful, synergistic ecosystem.
So if you're a plumber or an HVAC tech,
Chances are you've used a RectorSeal product, maybe without even realizing it. These aren't just tools. They're essential, trusted components. Professionals rely on that proven performance to get the job done right the first time. No callbacks.
makes sense. Okay, segment number 2.
Next, we move to specialized reliability solutions.
Okay, what's that about?
This segment is all about high-performance specialty lubricants, sealants, anti-seize compounds, contamination control products like the desiccant breathers that keep moisture out of sensitive equipment, plus sophisticated lubricant management systems, and even rail friction modifiers.
Rail friction modifiers, like for trains.
Exactly. To manage the friction between the wheels and the rails, it's built around legacy brands like JetLube, founded 73, and Whitmore, which goes way back to 1979.
Wow, long history there too.
Definitely. These aren't just any lubricants. They are highly engineered solutions for extremely demanding end markets. Think general industrial, energy, mining, rail transportation.
Places where equipment failure is catastrophic.
Precisely. Imagine the massive, expensive machinery in a mine, or the critical infrastructure of a railroad. Revenue here is driven by consistent, non-negotiable MRO needs. If you're maintaining heavy-duty gear in a mine, where downtime can cost hundreds of thousands an hour,
You're not going cheap on the lubricant.
absolutely not. You're relying on Whitmore's high-performance stuff. There's just no room for second best. Reliability is paramount. Brand trust and performance are simply non-negotiable for customers whose livelihoods depend on their equipment running flawlessly. The cost of a cheap, ineffective lubricant is exponentially higher than any savings.
Gotcha. Okay, and the third segment?
And finally, there's engineered building solutions. This one's a bit different.
How so?
It focuses on architecturally specified products for the commercial construction market. Architecturally specified means these aren't just off-the-shelf items. They're designed into buildings during the planning phase.
So specified by the architect or engineer early on.
Exactly. Specified by architects, engineers, sometimes interior designers, way early in the process. The products include the things like engineered railings, expansion joints. Those allow buildings to move with temperature changes or seismic activities, stair nosings for safety and durability, and critical building safety solutions like smoke and fire protection systems.
Important stuff for building safety and function.
Absolutely. These fall under trusted brands like Belco and Greco. Revenue here is directly tied to successfully bidding and executing commercial construction projects. They serve a broad range of sectors: educational, institutional like hospitals, multifamily residential.
So this one's maybe a bit more project-based than the MRO side?
Generally, yes, though there's still a replacement innovation aspect too. But the strategic rationale behind this whole three-segment structure is clear. Better alignment with specific end markets, clear operational synergies within each group, and a more focused approach to sales and marketing.
And those long-standing brands you mentioned, RectorSeal, JetLube, Whitmore, that underscores their deep brand equity, their trusted reputation.
It really does. And the Contractor Solutions segment's dominance, its strong focus on HVACR, is particularly crucial to the company's overall profile. It shows where much of its current strength and future growth is concentrated, given the consistent demand in that sector.
Okay, so these segments serve specific markets. Let's talk about their reach. While CSW serves a diverse range of end markets, which inherently provides stability.
Diversification helps smooth things out.
Right. But the HVACR market is clearly their biggest engine. It represented about 56% of net revenues in fiscal 2025.
Over half the business right there.
Yep, architecturally specified building products, that third segment accounted for about 17%, and the general industrial market for around 7%. Then you have other important markets like plumbing, electrical, energy, mining, rail transport, each contributing to that diversified yet focused revenue base.
So while diverse in offerings, that heavy concentration in HVACR means that market's health is really paramount to CSW's overall performance.
Makes sense. And geographically?
Geographically, their operations are predominantly in North America, mainly the U.S. This strong North American focus reduces some complexities, simpler supply chains, maybe easier regulatory compliance.
But also more exposure to the U.S. economy.
Exactly. It means their financial results are heavily influenced by U.S. economic conditions.
Hmm.
It is worth noting, though, they do serve customers in over 100 countries and have manufacturing in Canada and Vietnam.
Ah, okay. So some global reach and supply diversification.
Yeah, it adds a touch of global diversification to their supply chain and cost structure, even if the primary sales focus remains domestic.
So bottom line, if you're listening in the U.S., whether you realize it or not, you've almost certainly benefited from a CSW product somewhere in your daily life or work.
Very likely. From the AC system keeping your home cool, to the train tracks moving goods, or the vital industrial facilities powering our economy, they're often unseen, but essential.
All right, now let's dig into the foundations of CSW's strength. We're talking about its competitive moats and the broader market dynamics it navigates. This is when we really connect the dots to something truly compelling.
Yeah, this is the strategic underpinning.
Because CSW isn't just selling products, right? They're strategically positioned at the nexus, the intersection, of two massive ongoing megatrends: industrial technology and specialty chemicals.
That positioning is really key.
For me, this elevates them from just a good industrial company to a truly dynamic one. Let's talk industrial technology first. We mean Industry 4.0, even the emerging Industry 5.0, a world driven by smart manufacturing, automation, AI.
The connected factory, robotics,
Yeah,
all of that.
exactly. The global market for industrial automation was valued around, what, $212.6 billion in 2022? And it's projected to nearly double to almost $493 billion by 2032.
That's a huge growth rate, over 9% compound annual growth.
Huge. And smart manufacturing alone is forecast to grow at an even faster 14.2% CAGR through 2032. This is driven by this intense push for operational efficiency, better productivity, and more resilient supply chains.
And CSW's unique position isn't as a pure-play tech firm, right? They're not selling the robots themselves.
No.
Rather, they are a crucial enabler and beneficiary of these trends. Their products, even seemingly conventional ones like lubricants or sealants, are indispensable for ensuring the performance and reliability of these increasingly sophisticated automated systems.
So they capture value from that broader tech trend.
Exactly. It provides a powerful secular growth tailwind. And think about it. As industrial tech advances, as capital equipment gets more complex and expensive, does the demand for premium, reliable ancillary products actually increase?
You'd think so, right? You don't want your fancy robot failing because of cheap grease.
Precisely. The data suggests yes. Customers are less willing to risk high-value systems by using a lower-cost, generic consumable. The stakes are too high.
That's a perfect way to put it. Like CSW is the unsung hero behind the scenes. You don't see their stuff in the flashy robotics demo.
No, but that robot literally cannot run efficiently or reliably without their high-performance lubricants. They provide the essential glue for the future of industry.
Consider a state-of-the-art industrial robot, millions of dollars invested. It needs those high-performance lubricants from the specialized reliability segment to prevent costly downtime, ensure precision.
Or a modern, high-efficiency HVAC system, maybe in a LEED-certified building. It depends on advanced sealants from the contractor solutions segment to hit its performance ratings, its energy efficiency goals. These are mission-critical components, not optional extras you can skimp on.
Got it. And the other side of that coin, specialty chemicals.
Right. This is a vast, fragmented global industry. Market size estimates for 2023-25 range anywhere from, say, $627 billion up to over $1.1 trillion. Projected to grow at a healthy 3-5% CAGR.
Still huge numbers.
Huge. And unlike commodity chemicals, which are bought mainly on price and basic composition.
Bulk chemicals.
Exactly. Specialty chemicals are sold based on their performance and function. They solve specific problems. They deliver a unique value proposition. This allows for higher, more stable profit margins.
Which is a significant strategic advantage for CSW. It moves them up the value chain.
Absolutely.
Okay, so these broad shifts, industrial tech, specialty chemicals, they create powerful long-term tailwinds. But it doesn't stop there, right? There are other big macro trends pushing them forward.
Definitely. Several other powerful macro and secular trends are really propelling growth across their core industries.
Okay, like what?
First, let's talk automation and labor shortages. We're facing a persistent, growing shortage of skilled labor in many industrial sectors.
You hear about that everywhere.
It's a major issue. And it's not just a challenge, it's a powerful accelerant for investment in automation and robotics. Companies are automating not just for efficiency, but because they literally can't find enough skilled people.
Filling the gaps.
Precisely. This directly addresses labor voids, helps productivity goals, especially for U.S. firms looking to nearshore production.
Which brings us to the second trend, supply chain resilience and nearshoring.
Big topic lately.
Huge! Recent global disruptions, pandemics, geopolitical tensions, you name it, have driven a strong trend of nearshoring and reshoring manufacturing, particularly back to North America. This creates a significant direct tailwind for U.S.-focused industrial suppliers like CSW. Local production means local demand for their products.
These aren't just temporary fads, right? These feel like long-term shifts.
Absolutely. These are secular shifts reshaping the global economy. The third trend is the demand for high-performance materials. In construction, for example, there's growing demand for advanced materials that improve durability, boost energy efficiency, contribute to sustainability.
And specialty chemicals are key there.
Critical. CSW's advanced sealants, coatings, fire protection systems, they fit right in. And fourth, predictive maintenance.
Moving beyond just fixing things when they break.
Exactly. The adoption of IoT, the Internet of Things, and AI is fundamentally shifting industrial maintenance from reactive to proactive, predictive. This increases demand for high reliability components and consumables, things like CSW's specialty lubricants, sophisticated filtration products. Because in a predictive system, you need components you can absolutely trust to perform without fail for longer.
Yeah, if you think about it, a factory facing skilled labor shortages, they're not just going to stop maintaining their machines. That's not an option.
No way.
Instead, they'll invest more in automation to compensate. And those automated systems, in turn, demand the highest quality lubricants and sealants to keep running without that costly downtime.
And CSW's heavy focus on MRO provides that strong, almost counter-cyclical layer of resilience, because maintenance spending is generally far less discretionary than spending on new projects, even during slowdowns.
You might delay building a new factory wing, but you can't delay fixing the critical machine that keeps the existing factory running. Precisely. And these powerful trends, combined with their product strategy, contribute immensely to what makes CSW's competitive position so strong, which leads us right to their formidable moat.
Ah, the moat. Warren Buffett loves talking about moats. This is what truly defines a high-quality business, right? Protecting its profits, its market share. And CSW seems to have some really formidable barriers to entry in its chosen niche markets.
They really do. First, and arguably most important, is their brand equity and reputation.
We talked about those old brands.
Exactly. They boast a portfolio of well-established, highly trusted brands, some decades old: Rector Seal, Whitmore, Jetlube. In professional industrial settings, brand reputation isn't just marketing fluff, it's critical. End users know product failure can be catastrophic, huge financial losses, even safety hazards.
That trust built over decades, you can't just buy that overnight.
You really can't. But arguably, their most significant competitive asset, the thing that gives them a tremendous strategic advantage, is their distribution network.
Okay, tell me more about that.
CSW has developed this incredibly robust multi-channel network. They use specialized buying groups, national accounts, and literally thousands of vast wholesale distributors. This ensures wide product availability across North America.
So they can get their products almost anywhere, easily.
Pretty much. And this network is immensely difficult and prohibitively expensive for a new entrant to replicate. Think about building those relationships, that logistical footprint, from scratch.
Wow.
And what's truly fascinating here is how this distribution network isn't just a sales channel. It's a strategic asset. It's almost like a superpower for their M&A engine.
How so? A superpower?
Well, they acquire a strong product from a smaller company, maybe one with limited reach. They then plug it into their extensive network, and boom, instant scale, wider market penetration, immediate revenue synergies.
Ah, so it turbocharges the acquisition.
Exactly. It creates this powerful self-reinforcing flywheel effect that accelerates the growth of every company they buy.
Imagine trying to convince a pro HVAC contractor, right, someone who relies on their tools every single day, trying to get them to switch from a Rector Seal sealant they've trusted for 30 years, know it works perfectly, just to save a few pennies on some cheaper, unproven alternative.
It's a non-starter. The risk-reward calculation is just not there.
And that perfectly illustrates their niche market leadership. Their whole strategy is to be number one or number two in specific, often overlooked niche applications, like those HVACR sealants or the high-performance rail lubricants.
They stay out of the commodity knife fights.
Exactly. This focused approach lets them avoid intense price competition. They're not fighting in crowded commodity markets. It lets them command premium pricing for superior, trusted performance.
And this ties directly into the fourth pillar of their moat, switching costs and specification.
Okay.
As we discussed, CSW products are typically a small percentage of the total value of the asset they protect, the HVAC unit, the industrial machine. This creates high implicit switching costs.
The cost benefit just doesn't pencil out for switching.
Exactly. Why risk a $100,000 piece of equipment to save $50 on a lubricant? The math doesn't work.
Mm-hmm.
Furthermore, in that engineered building solutions segment, those products are often specified by architects and engineers early in the design phase,
Right, locked in early.
which effectively locks in sales for the duration of that construction project. It's incredibly difficult and costly to change specifications once they're approved and integrated into the plans. This combination, brand trust, distribution, niche leadership, switching costs, specification, makes their competitive position exceptionally strong and durable.
Wow. When you put it all together like that, the deep trust, that unrivaled distribution, the niche leadership, those high switching costs, you see a business that's not just growing, but doing it from a position of immense strength.
Mm-hmm.
And this robust competitive advantage must translate directly into their financial performance, right? Which you said has been pretty impressive.
It absolutely does. Let's talk about the engine of growth at CSW Industrials, the financial results. They have a really impressive 5-year track record looking from fiscal 21 through the trailing 12 months, or TTM, of fiscal 25. They've consistently demonstrated robust growth, strong profitability, and excellent cash flow generation pretty much since their 2015 public debut.
Okay, hit me with some numbers. How impressive.
Well, look at revenue. It almost doubled in just 4 years.
Doubled. Wow.
Yeah, climbing from about $419 million in fiscal 2021 to over $915 million in the most recent TTM for fiscal 2026. That's serious top-line expansion for an industrial company. Year-over-year growth rates were strong, including a huge 49.4% jump in fiscal 22 and a solid 12.3% for the TTM of fiscal 25. This isn't just slow, steady growth, it's powerful acceleration at times.
But is it profitable growth? Sometimes companies chase revenue at any cost.
That's the truly remarkable part here. This aggressive growth isn't coming at the expense of profitability, which is, as you say, a common pitfall. CSW's business model is inherently highly profitable. Gross profit margins are consistently strong. 44.8% in fiscal 25, 43.8% on a TTM basis. Operating margins typically range from the high teens to over 20%.
That's pretty healthy for industrials.
Very healthy. And this margin resilience, even when the economy fluctuates, it underscores their pricing power and the essential value-added nature of their products. They're not just selling widgets, they're selling solutions people rely on.
And that flows down to the bottom line.
Directly. Strong net income growth, expanding from about $40 million in fiscal 21 to a robust $139 million in the TPM of fiscal 25. Similarly, diluted earnings per share, or EPS, grew from $2.65 to an impressive $8.37 over that same period. These are the hallmarks of true value creation. They're growing profitably and sustainably, not just chasing scale.
And it's not just profit on paper, right, or EPS games. It's about real cash you can use.
Exactly. Cash flow is king. And the company is a prolific generator of cash. Operating cash flow reached a substantial $166.4 million in the TTM of fiscal 25.
Yeah.
Free cash flow, FCF, that's the cash left after capital expenditures, the money available for other things.
Like acquisitions or dividends.
Precisely. FCF was at a robust $150.3 million for the same TTM period. That's a significant war chest, readily available to fund their strategic priorities. It's the lifeblood supporting their capital allocation, especially acquisitions. It directly fuels and validates their buy-and-build model, letting them continue that growth trajectory without excessive external financing.
So this strong financial performance, it's clearly fueled by a dual engine, you could say.
That's absolutely right. CSW's growth story is a balanced, dynamic blend of both organic expansion, growing the existing businesses, and inorganic growth through acquisitions.
Okay.
In certain periods, like fiscal 2022, revenue growth was almost evenly split between those two powerful drivers. Showed a nice balance. More recently, like in Q1 of fiscal 2026, acquisitions became a more prominent driver. That helped strategically offset some slight reductions in organic volumes in segments like contractor solutions, which can be sensitive to broader economic conditions, like housing starts.
So M&A can smooth out the bumps.
Exactly. What's really compelling here is how this dual-engine approach provides incredible strategic flexibility. Even when organic growth might hit a temporary speed bump due to macro factors, maybe a construction slowdown, a dip in industrial activity,
Hmm.
CSW has this powerful M&A engine that can kick in and keep the company moving forward.
Like having a backup generator.
Kind of. A backup engine that's just as powerful as the primary one, ensuring consistent progress, generally, regardless of the broader economic cycle. It validates the effectiveness of their buy-and-build strategy as a consistent, reliable growth lever.
So what does this mean for you as an informed observer, maybe a potential investor? It means the company isn't solely dependent on unpredictable market cycles for growth. That's a powerful differentiator. It provides a higher degree of predictability and resilience in their overall performance.
It's definitely a key strength.
Okay, moving beyond just growth, let's look at efficiency. How well do they use their capital? The company demonstrates a consistent, almost obsessive focus on operational excellence and capital efficiency. Their return on equity, ROE, was recently reported at a healthy 15.5%. And maybe even more telling, their return on invested capital, ROIC, stood at 10.7% on a TTM basis.
Okay, ROIC. Let's unpack that. When we talk financial efficiency, ROIC is often considered the ultimate report card for management. How well are they putting money to work?
Right. Are they getting a good return on the money they invest?
Exactly. For every dollar CSW invests, whether it's in a new acquisition, a factory upgrade, R&D, they're consistently getting more than 10 cents back in profits, after accounting for all their costs of capital. A consistent ROIC above 10% isn't just good. In the industrial world, it's a golden signal.
Separates the wheat from the chaff.
It really does. It separates the truly efficient operators from the merely busy ones. It confirms they're investing in projects and acquisitions that genuinely create economic value and have that durable competitive advantage we talked about. These returns signify highly efficient, profitable capital deployment. It's a crucial indicator of a high-quality, well-managed business.
Yeah, an ROIC consistently above 10%, that's a golden signal. Tells you that for every dollar they put in, they're getting more than a dime back in returns. Hallmark of truly effective management, strong competitive position.
Couldn't agree more.
All right, that brings us neatly to Section 4. Steering the ship management and strategy. We've dissected the what and the how of CSW's business, their products, segments, markets. But none of this happens by accident.
No, it requires strong leadership and a clear plan.
Behind every strategic move, every acquisition, every financial decision, there's a leadership team with a guiding philosophy. So let's pull back the curtain. Let's look at who's steering this ship and the deliberate strategy that underpins their long-term success. CSW Industrial's management team operates with a really clear, consistently communicated long-term strategy. It's built upon 5 core pillars that guide basically all their operational and financial decisions.
And these aren't just, buzzwords on a slide deck.
No, these feel like deeply ingrained principles that have allowed them to achieve the kind of performance we've been discussing. Pillar 1, maintain a strong balance sheet. Prioritize financial strength, ample liquidity, above all else.
Prudence first.
Second, allocate capital efficiently. Deploy capital to the highest risk-adjusted return opportunities with a clear, disciplined hierarchy. Third, maximize channels to market. Relentlessly leverage and expand that robust distribution network we talked about.
That distribution network, again, key asset.
Fourth, invest in innovative products. Focus on customer-driven R&D for value-added solutions that solve real problems. And finally, fifth, employ a strategic and disciplined acquisition approach. Execute a rigorous, selective M&A strategy, quality over quantity.
If we connect this to the bigger picture, this structured, disciplined approach, particularly in capital allocation, is often what truly separates the great industrial compounders from the merely good ones.
How so?
It provides a high degree of confidence in their decision-making. That strong emphasis on a strong balance sheet and efficient capital allocation really differentiates them, especially in an industrial sector where, let's be honest, sometimes less disciplined M&A happens may be driven by ego rather than value, and it could destroy shareholder value. This framework is a core reason for that consistent ROIC we just discussed.
Okay, so those 5 pillars form the strategic foundation. But let's look at the key growth drivers actually fueling their future expansion. CSW's growth comes from a multifaceted approach, combining that inorganic expansion, the acquisitions, with robust organic initiatives.
Right, the dual engine in action.
As we mentioned, strategic acquisitions are arguably the most significant driver. It's a core competency for them. They acquire well-run businesses with leading product lines that complement their existing portfolio and, crucially, can be scaled rapidly via their existing powerful distribution network.
And plug-and-play capability.
Exactly. Recent examples. That substantial Aspen Manufacturing acquisition $313.5 million for HVAC components back in March 2025. That's a significant transformative deal. But also smaller bolt-on deals like dust-free, PSP products, PF Waterworks in 2024.
Those bolt-ons add up too.
They do. And here's where it gets really interesting for you, the listener. Imagine a smaller company, right? Fantastic, innovative product, but limited sales reach. They've got a great mousetrap, but maybe only sell it in a few states.
Right, common scenario.
CSW comes in, buys them. Suddenly, that product is available through hundreds, maybe thousands of distributors they already work with across North America. That's an instant growth accelerant for the acquired company and powerful synergy for CSW.
And this strategy is particularly potent with those smaller bolt-on deals. They can often be seamlessly integrated, minimizing risk, rapidly realizing synergies through CSW's established channels.
Oh.
However,
There's always a however.
there is. It raises an important question. Can they maintain this high success rate and efficient integration with larger, more complex acquisitions like Aspen? The Aspen deal is substantial. It nearly doubled the size of their contractor solutions segment.
Wow, that's big.
It is. The successful integration of Aspen will be a crucial indicator of their ability to scale their buy and build model to a new level. The market will be watching that very closely. Larger acquisitions, while potentially transformative, inherently carry a higher degree of execution risk.
Makes sense. Okay, beyond acquisitions, what else drives growth?
They also prioritize new product development and innovation. But it's not necessarily about inventing flashy new gadgets. It's about solving real-world practical problems for their customers.
Like that example you gave earlier.
Yeah, maybe consolidating two different sealants into a single, easier-to-apply product. Sounds minor, right? But for a contractor on a tight deadline, it means faster work, less potential for error, one less SKU to manage. That's a tangible improvement in efficiency.
Or smart condensate pumps that detect issues before a flood.
Exactly. Those kinds of subtle, practical innovations build fierce customer loyalty and contribute directly to their competitive moat. Then there are market share gains and cross-selling.
Using that distribution network again.
Leveraging those powerful channels and strong customer relationships to introduce acquired brands and existing products to a wider audience creates significant cross-selling opportunities. If a distributor trusts CSW for one product line, it's much easier to introduce another complementing product from CSW's portfolio.
Makes sense.
And finally, geographic and market penetration. Just continued deeper penetration within existing North American geographies, extracting maximum value from their core markets. While the primary focus is domestic, there is potential for targeted international expansion over the long term, once North America is more saturated.
Got it. And CSW also differentiates itself with that highly disciplined, transparent capital allocation approach you mentioned.
Yes, they have a very clear hierarchy. Priority 1, organic initiatives within existing businesses. Invest in what you have. Priority 2, inorganic growth through strategic acquisitions. Priority 3, and only third, returning cash to shareholders.
So reinvestment comes first.
Generally, yes. It's not just about spending money. It's about investing it wisely. So they're not just growing for growth's sake. They're growing responsibly, always ensuring that balance sheet remains rock solid. That provides flexibility for the future.
And that sophisticated capital allocation framework, you mentioned it's influenced by the CEO's background.
Yeah, CEO Joseph Arms has a private equity background. That discipline is a significant competitive advantage. It helps them avoid value-destructive acquisitions or maybe poorly timed buybacks. It reinforces investor confidence and helps justify that premium valuation.
Do they return cash to shareholders at all?
Oh yes, they have a strong, consistent track record, a stated policy of consistently increasing quarterly dividends. As of July 2025, the dividend was $2.27 per share, marking 6 consecutive years of increases.
6 years, that's a good trend.
It is. And they also use opportunistic share repurchases. They authorized a $100 million program back in December 2022, which signals confidence in their own valuation.
And their financial health, you said, is a core tenet.
Absolutely. Yeah. Not just a fleeting goal. They meticulously maintain a strong conservative balance sheet. Their debt-to-equity ratio was remarkably low, just 0.16 in the TTM of fiscal 25.
Very low leverage.
Very low. This financial prudence provides critical flexibility for funding future acquisitions and weathering potential economic downturns. And they proactively manage resources. They upsized their revolving credit facility to $700 million in May 2025, specifically to provide substantial liquidity for future M&A. shows foresight and readiness.
Okay, finally, let's look at the leadership and governance, the foundation of trust and accountability.
Right, who's actually running the show.
Yeah.
The management team is led by a group of seasoned veterans, deeply experienced in industrial markets and corporate finance.
Like Joseph B. Arms, the CEO.
Exactly. Chairman, CEO, president since 2015, crucial background in M&A law, former CEO of Capital Southwest. James E. Perry, the EVP and CFO since 2020, strong financial background from Trinity Industries. And Donald J. Sullivan, EVP and Chief Strategy Officer, has deep operational experience in HVAC from industry giants like Goodman Global and Carrier.
So real industry chops on the team.
Serious chops. Joseph Arms, in particular, his background is all about smart capital allocation, strategic growth. It perfectly suits CSW's buy and build strategy. That relevant experience minimizes execution risk.
And how are they incentivized? Does compensation align with shareholders?
Very much so. Executive compensation is significantly at risk. It's tied to very specific performance-oriented metrics. Short-term incentives are tied to consolidated EBITDA and operating cash flow.
So profitability and cash generation.
Right. And long-term incentives are tied to relative total shareholder return, TSR, against the Russell 2000 index over 3 years.
So beating the market.
Exactly. This meticulously designed structure ensures management is paid for delivering the right kind of performance, sustainable value creation, market outperformance, not just chasing short-term gains. It directly aligns their interests with shareholders.
And corporate governance, board oversight.
Robust. They boast a diverse board of directors with experienced leaders from prominent industrial and chemical companies. Think Dow Chemical, Lennox International, Rockwell Automation, brings a wealth of industry knowledge and oversight. They also have shareholder-friendly policies, strong stock ownership guidelines, anti-hedging pledging policies, a clawback policy for incentive comp, all designed to protect shareholder interests and foster long-term thinking.
Okay, let's quickly touch on some recent developments. How has CSW been navigating the macro challenges from, say, 2023 to 2025?
Yeah, these developments show their dynamic nature, management's active role, not just passive reaction. Strategically, they transferred their stock listing to the prestigious New York Stock Exchange, the NYSE, back in June 2025.
Why do that?
Strategic move. Enhances trading liquidity, market visibility, potentially broadens their investor base. They also accelerated M&A activity, 3 bolt-ons in 24, and of course that big Aspen acquisition in March 25. Shows confidence, continued execution even in uncertain times.
And how did they handle the macro headwinds? Inflation, supply chains?
They've been adeptly navigating that uncertain environment. Increased material costs, freight expenses, supply chain pressures. They faced all that. We saw some softness, which wasn't entirely unexpected, particularly in contractor solutions. Housing starts cooled, commercial projects face delays due to rates and costs.
So how did they respond?
What's interesting is how management communicated it. They clearly distinguished between cyclical slowdowns and their underlying organic growth path. They emphasized the resilience from that MRO focus, which tends to be less discretionary.
New installs might dip, but maintenance continues.
Exactly. They highlighted that while new installations might dip, the existing stock of buildings and machinery still needs constant maintenance, cushioning the blow. Risks include ongoing tariffs, especially from China, Vietnam, which they actively manage through strategic sourcing.
So not resting on laurels, actively making moves.
Definitely. They're making strategic moves to enhance market position, ensure financial flexibility for future growth, even when the economy gets bumpy. That $700 million upsized credit facility in May 25 is a perfect example. Proactive step, underscores commitment to growth, ability to secure financing.
All right, let's put on our investor's lens now. Section 5, valuation and risks. You mentioned CSW typically trades at a premium valuation compared to the broader industrial sector, even its peers. Why is that?
Yeah, that premium valuation. It's largely substantiated by everything we've discussed. CSW's superior historical and projected growth rates, those consistently high returns on capital, ROIC, that highly defensive earnings stream from the MRO focus, and critically, the proven quality of its management and strategy.
So the market recognizes the quality.
Essentially, yes, it's a case of paying a fair price for an excellent business, rather than seeking a cheap price for a merely fair one. This brings together all the strengths, the powerful moat, the dual growth engine, disciplined capital allocation, explaining why the market values them highly and is willing to pay more for their earnings.
Okay, to really understand that premium, let's compare CSW to some highly regarded industrial peers. The analyst report mentioned Illinois Tool Works, ITW, RPM International, 3M, and Graco.
Right, a solid peer group. Companies with similar industrial construction exposure, strong brands, value-added products, often acquisitive growth models.
Now, an astute observer might look at their trailing 12-month PE ratio, price to earnings, currently around 36.4 times earnings, and might instinctively think, whoa, that's rich for an industrial company.
And they wouldn't be wrong. It is a significant premium compared to giants like ITW at 23.2 times, RPM at 23.4, or Graco at 29.3. This tells you the market has very high expectations for CSW's future earnings growth.
But is it justified?
Well, what's fascinating is that despite these seemingly elevated multiples, the analysis suggests the premium is justified by their superior historical performance, consistent value creation, and the inherent durability and resilience of their business model. It's a testament to the quality.
What about other metrics like EV/EBITDA?
Good question. Their trailing 12-month enterprise value to EBITDA ratio, a key multiple for comparing industrials because it normalizes for capital structure, is around 20.5 times. That's actually in line with or slightly above high-quality peers like Graco, 20.6x, and ITW, 18.8x, though higher than RPM, 16.9x.
So still premium, but maybe less dramatically so than PE.
Right. And also look at their dividend yield at 0.4%. It's lower than the peer group average of 1.4%. Another strong indicator. It suggests management and investors prioritize reinvesting earnings back into the business for continued high return growth rather than a high current income payout.
So the investment thesis is basically they keep executing, they grow into this multiple, maybe even expand it.
That seems to be the market's view. Continued strategic execution justifies the premium.
Okay, while CSW is undoubtedly strong, any comprehensive analysis has to look at risks. Even with that defensive MRO buffer, they're not immune, right?
No company is immune. One significant business risk is simply economic cyclicality. Given their exposure to HVACR and commercial construction, while MRO is defensive, new installations could be more sensitive to slowdowns. If new construction activity takes a big, prolonged hit, it would impact them.
Makes sense. What others?
Supply chain and input cost volatility, raw materials, freight costs, tariffs especially related to China-Vietnam sourcing. Rising costs for key chemicals or metals could squeeze margins if they can't fully pass them on. Competition is always there, too, from big diversified players and nimble regional specialists.
And the big one for their strategy, M&A risk.
Exactly. M&A execution risk is particularly pertinent given their core buy-and-build strategy. The potential for overpaying, integration difficulties, failing to achieve synergies, uncovering unforeseen liabilities, it's always there.
Which raises that question again. How well can they integrate larger deals like Aspen? That's a significant test, carries inherent risk.
It really does. On the financial side, while the balance sheet is conservative now, indebtedness could increase with future large acquisitions, and currency exchange rate fluctuations can affect their international sales and costs. Lastly, market and regulatory risks. Things like reliance on key distributors losing a major one could hurt sales, and changes in regulations, environmental safety, building codes could increase costs or change demand patterns.
Okay, so plenty to watch. What about catalysts? What could shift the valuation, up or down?
Good question. For multiple expansion positive shifts, keep an eye on continued outperformance on organic growth relative to their end markets. That shows the core business is strong.
Proving the model works even without M&A sometimes.
Right. Also, the successful, highly accretive integration of large acquisitions like Aspen. If they nail that, it proves the scalability of their model to a new level. And of course, sustained high levels of ROIC will continue to reinforce confidence. If that Aspen integration is a huge synergistic success, driving substantial growth, that could really move the needle on valuation.
And catalysts for contraction, the downside.
Conversely, catalysts for multiple contraction negative shifts would include a significant, prolonged economic downturn, severely impacting construction and housing. That could test even their MRO resilience. A major misstep in M&A is a big one. An overpriced deal that fails to deliver causes operational chaos.
The market hates M&A screw-ups.
Hates them. And
Right.
finally, a sustained period of margin compression, maybe they can't offset inflation, tariffs, or competition bites harder, that could erode investor confidence. Any significant missteps or sustained micro headwinds that compromise their growth story could lead to a market re-rating of the stock.
Got it. Okay, that brings us to the end of our deep dive into CSW Industrials. Wow, we really unpacked this company.
We covered a lot of ground.
From its disciplined origins as a spin-off with a clear mandate to its evolution into this formidable niche market compounder powered by that proven buy-and-build strategy. You've seen how their portfolio of strong, trusted brands coupled with that extensive, almost unrivaled distribution network, and their focus on critical MRO-focused products. It all creates this powerful, self-reinforcing competitive moat.
Well-defended business.
This entire structure consistently delivers superior financial results and, as we explored, justifies that premium valuation the market awards them. We've also highlighted the risks, outlined exactly what to watch for as their story unfolds.
And if we connect this to the bigger picture, CSW really exemplifies how strategic focus, disciplined capital allocation, and exceptional execution, even in what might seem like traditional, less glamorous industrial sectors, can generate truly significant long-term shareholder value.
Yeah, it's not always about the flashiest tech.
Not at all. Their ability to synthesize diverse market trends, capitalize on those secular tailwinds, maintain a strong financial profile. It's truly notable.
Yeah.
It shows that innovation isn't just about gadgets, but about operational excellence and shrewd strategic positioning in essential markets.
Well, hopefully this deep dive has given you, our listener, a clear, comprehensive, genuinely insightful picture of CSW Industrials. Hopefully equipped you with an understanding that goes far beyond a quick news headline or a simple stock quote. You now have the knowledge, hopefully, to see the unseen force at work behind so much of our daily infrastructure.
And thinking about that future, it does raise an important question for you to consider. As Industry 4.0 and nearshoring continue to accelerate, and CSW keeps robustly growing its ecosystem of niche solutions through that powerful M&A engine, how much larger can it truly become?
Is there a limit?
Well, is there an ultimate limit to a niche market compounder before it potentially loses the agility, the focused advantage that have defined its success so far? Or will its increasing size simply solidify its position as the dominant consolidator in these fragmented essential markets? Does scale eventually become a hindrance in niche markets?
Something to mull over as you go about your day, right? Thanks for joining us on this deep dive.